I sold my first put option on MSTY, and I just wanted to tell you about it. Hello my friends, this is Legend. I know in previous videos I had mentioned something about doing an option play on MSTY, and I decided to try one out, and I sold my first put option on MSTY. Now I have sold puts and calls before on other stocks, but I've never done one on the YieldMax ETFs. There's no difference in it, honestly, as far as in how you do it and how you sell it, but I just never did one on the YieldMax, and I just kind of wanted to show you where I got in at and the amount of premium that I earned, and show you the expiration date and so forth. So I'm going to go over to the Webull chart, and I'll show you the chart on MSTY, and then show you my strike prices and everything else, and what led me to get in when I did, and what I'm looking to do in the near future when it goes X this week. Okay, so here we are on the Webull chart, and we're looking at MSTY currently right now. And I've got the day interval pulled up, and so each candle here represents one day. So this candle that we're currently looking at, let me zoom in here just so we can get a better view, because it is a very short candle here. This is the candle for today. Of course, this is after hours currently, but this was the close of today, and that was $27.27. I actually did not sell one today. I actually sold a put on it on Friday. What I did is I saw the stock going down a little bit, so I just put in a amount that I was willing to buy the stock at, so that would be my strike price. And then I put in a premium that I wanted to earn for that play. So I did this on Friday here. The reason that I got into it is because we're looking at the Bollinger Band here. This is that yellow line, the blue line, and that white line. The white line is the upper portion of the Bollinger Band. The blue, of course, is the middle, and you've guessed it, the yellow is the bottom of the Bollinger Band. So for whenever I am looking to sell a put, meaning that I am willing to buy shares at a particular price. So when I sell it, I am the one that's going to receive the premium. Okay, so what I'm looking at here is I want that candle to be close to that bottom of the Bollinger Band here. Definitely want it under the mid. Okay, so on Friday, which is this little red candle here, it was kind of going up and down during the day, of course, and we can look at the 5-minute chart on that one just to kind of give a better idea of what I mean by going up and down. So let's look at that, and this is the Friday chart here, and let me zoom out a little bit so we can get it all on the screen here. And as you can see, it came out at probably around that $27. It went as high as $27.68, and it went as low here as $26.66. Now, I did not catch it down here, of course. When I saw the stock starting to drop from up here, I just happened to look at the ticker and look at the stock chart during this time, and I saw it starting to drop around my lunchtime break. And so what I did is I just decided to put in a certain amount of premium that I was wanting for that strike. And I think at the time I put it in, it was probably around about $60 roughly for the premium to sell that option. And I put in that I wanted 80, right? So if that way, if it kept going down, eventually, hopefully it would get down and then it would earn me more premium for that same play. Now let's just take a look at the option chart here in a second to better understand what it is that I'm talking about and the strikes that I selected. But I just wanted to show you that I noticed it about right here that it was kind of starting to come down. I didn't know if it was going to turn around and go on back up, so that I wanted more, and so I put in a low amount of $25 strike, because I'm thinking that if MSTY pays out about a $2 distribution, and if it's sitting at $27 here roughly, $2 distribution would take it down to a $25, and if I can get it at $25 and earn a premium on top of that, where I'd put in earning $80 for it, that would come out pretty good for me. I wouldn't mind buying it at $25, and they're going to pay me to do so. So that's the reason I did that. And I did it for a shorter time period. And like I said, we'll see that once I go over to the option chart there. But like I said, you know, what I was doing here back at the day chart, what I was looking for is it on the day chart is to be down close to or at the lower portion of that Bollinger Band, which is that yellow line. Back here would actually been a good time to grab it if you grabbed it when it dropped, not maybe so much as it went on back up. But usually when you're selling a put, you want to do it on a red day. As the price is coming down, it'll pay you a little bit more premium on that. So let's take a look at the option chart here, and this is the what they call the option chain. Okay, so as you can see, it won't be, there's no way really that I can show you what it looked like at the time that I had got it, but if we go back to the chart and we look at that 5-minute chart again, I know that I got in around the 15 hour, and you can see there's the 14. All right, so we will zoom back out a little bit here, and at that 15 hour right here between these two candles is where it actually triggered, and it paid me the $80 or 80 cents per share. And when you're doing an options contract, each contract is a total of 100 shares. And we see on the option chain where it says a certain dollar amount, or you know, in cents or dollars, that will mean that is per share. Okay, so this basically is where I was at when it triggered and it sold that put on MSTY. Round about that $27 is where it ended up going through, roughly 27. So if we look at the option chain here, so it was probably sitting pretty close to about where it is right now, and I had sold it for February the 21st. Now, for this one, I sold a $25, and this is the 25 right here. This is the prices here that you can select from for your strikes. The one in the middle here, where it says 27.27, this is the price, the current price, or in this case, the closing price for the day. So on this side here is the puts, as you can see up here, and this side is the calls. And you might be able to tell a little bit of a color difference here. This is a little bit more shade of bluish purple, and this down here is gray and black, and it's the opposite for this here. And what that means is on your puts here, where $27 is less than the current price of $27.27. So that means this is out of the money because we are looking for the price. If it goes down, then it will possibly trigger me and force me to purchase those shares at whatever strike, and these are the strikes here, that I would select. In my case, I selected the 25 right here. So I selected a $25 strike. I picked for February the 21st of 2025. So this will be for next week. And I know that MSTY does go X this week, but at the time I was just wanting a little bit more premium than it was willing to pay because it was only 1 week out. So I made it for 2 weeks out. Now the one, once it goes X this week, I may look to actually sell another put on this one on the X date. And that should pay me a little bit more premium if I do a close to the money. Because as you can see here, the $25 strike is the one that I selected. And if the current price was around at 27 and I earned 80, and the current bid price is 50 cents and the ask price is 65. So the bid is saying basically that is your sell price and the ask would be the buy price. Okay, so if you bought it at the high, currently is 65 cents. And if you turned around and sold it and you sold it at market, it's probably going to sell at the 50 cent. And that's why I don't do market orders. I do limit orders. And a limit order helps a bit because that means I set what it is that I want. And a market will just go for whatever it is at the market at that time. So a lot of times when I do a limit order, I will sell and set that limit for the mid price. And that's what this number here is. And you can see up here it says mid. I come down here to my 25. Right now it's 58 cents. Now at the time when I did it on Friday, I actually got 80 cents, right? But it was around 60 when I first placed the order. Then I put a limit and I will put it in for 80 cents because if it went through, I would like more. But if it didn't get there, then of course it would not have gone through and I would not have earned that 80 cents per share. But for mine, this was 80 cents that I earned for the $25 strike. So since it's a put, I am saying that I am willing to buy the shares of MSTY, 100 shares, because I have one contract. So I am willing to buy 100 shares at $25 if the price of the stock here goes below 25. So if it goes below the 25 or at 25 technically, then I will and could be put the shares. Now it's not guaranteed that you would be put the shares because sometimes it goes through, sometimes it don't. Now in the perfect world, what I would like for it to do is at time of expiration, and the expiration be in February the 21st, 2025. And that's this number up here. And that's my expiration date that I selected for the $25 strike that I selected and earned the 80 cents per share of what I selected, right? And 100 shares, so I earned 80 bucks. Now, if that price does not get down to 25, if it goes down to $25.01, then this contract will expire worthless, meaning that this amount here where it says 58 cents right now, it will go to zero on that expiration date if that price is above 25. And since it goes to zero, that means that it will expire worthless and the contract will just dissolve. Because no one's going to want to force me to buy shares at 25 when the price of the stock is over $25, right? because you think about it, if the price was $25.50, that would go worthless, right? So I would not get put to shares. I keep the 80-cent premium, which I keep that no matter what anyway. Then nobody is going to want to assign shares to me at 25 because they'll lose 50 cents a share. Why would they want me or force me to buy shares at $25 when I can turn right around immediately and sell them for $25.50 and make 50 cents? So just to show you, it doesn't make sense. Now, if the price goes to $24 at expiration and I have a contract that I'm saying I will buy those shares at $25, then yes, I could be put those shares and I would have to buy 100 shares at $25 each. So therefore, that would be $2,500 to purchase those 100 shares, even though the price of the stock is $24, right? So you could see where me having to buy those shares at $25 when the stock price is $24 may sound like a bad deal, right? Because I am paying $1 more than the actual price of the stock, right? But I didn't know it was going to 284 anyway. I was willing to buy them at 25, so I do end up buying them at 25, but I earned 80 cents per share, so my actual average per share would be $24.20, right? Because it's $25 what I paid minus what I earned of $80 or 80 cents, then that takes it to $24.20. So that's my average. So now it's not looking so bad, right? And even if it's at $24.50, I would still get put the shares at 25, but I got paid 80 cents. So I'm still actually in the good by 30 cents per share. I wouldn't mind owning them a lower, but when the time comes, I could also roll that position, meaning I could extend out my expiration date and I can lower my cost here, what I'm willing to pay, and possibly still earn a premium. But for now, I have a $25 put option that I sold, and I earned a total of $80 for that option. That expires February the 21st. And I will probably let that one go pretty much right up to expiration and then look to reevaluate it if I want to roll it, or do I just want to let it expire. If it expires worthless, great. I can do another option on it and I would shoot that out a whole month. But like I said, MSTY does go X on Thursday of this week. So at that day or in that time, I can look to sell another put on the X date because the price of the distribution will come out of the price of the stock. And then I could sell a pretty close to the money option put on that play and do it out for about 1 month. Right? So I would shoot it out to March the 21st, I think it is. Let me see, March the 21st here. So I can shoot it out to here at that time. Now what you got to also notice is this being the price, and let me go back so we don't get too confused. I'm going to go back to the 21st here. So as you can see, the closer to the actual price of the stock, this middle line here, 27.27, is the price that it closed at. The closer you are and you're going to sell your put to that actual price, the higher the premium. All right? And we'll just look at the mid numbers here because this is the bid, this is the ask, and this is the mid. The mid being between these two numbers. Now you can't always earn that mid, but that is usually what I always try to get. I always put it in for the mid, sometimes a little above the mid if there's a lot of movement in the stock at that time. But as you can see here, the closer I get to that 27.27, the premiums are higher. There's $1.72 for a 27 strike. And then you can go to a 26.50 strike and it's $1.48. A 26 strike is $1.12. So it's a juggling act that you have to select, right? You've got to decide, how far out of the money do you want to go? So if it's 27.27 is the current price, what are you willing to buy your stock at? What are you willing to buy MSTY at? So this could be a time where if you have an average price of, say, $26.50, you could sell a $26 put option, and you could earn $1.12 even from just today. That would expire February the 21st. So you would essentially average down on your play and earn a premium by doing so. Now, I know there's a lot to options, and some of this is assuming that you've done options before, and I've tried to explain a few different things, but there is a lot to it, but it's actually not as difficult as it looks. It's actually quite easy to sell options. You can sell a put, like what we're talking about here, saying that we are willing to buy those shares at a certain price that we select. And for doing so, we get paid a premium. Well, say you got put the shares, so I get assigned the shares on February 21st. The price of the stock is $24.50. I had a $25 strike. Since the price did go below my strike, I am going to get put those shares. So I will be forced to purchase those 100 shares at $25. Well, the current price now is $25. And at that time, this middle here will now say whatever that actual price is, which was like, say, the $24.50, right? So I'm kind of shifting everything. You kind of got to, play in your mind a little bit when I'm shifting these numbers. But my point is, you could turn right around and you can sell a call, okay? You could sell a call for, in this case, the next one up. So you put the shares at 25. So you could sell a call at $25.50. So you would earn 50 cents per share if the price of the stock got above that, because now we're talking about selling calls. And if it did get above it, then your shares would be called away. All 100 shares would be called away, and you would sell them and be forced to sell them at $25.50 because that is the strike that you selected. But by doing so, you would have earned premium. Now, again, since that is in the future and the numbers here are not going to show you what the premium that you would actually earn would be, because that's not the price of the stock currently. But as you can see here, the $27.27 for a 1 month out, say we'll do it for March the 21st, that's a little over a month out, and you sell, even from the current price, you sell up to the next strike, that can pay you another 60 cents right there. It says 62 for the mid. So you can continually play these if you do let it get assigned. And of course, if you don't want to get it assigned on the put side, you can always roll it, meaning you can extend out your expiration date and you can change your strike, preferably to roll it down, right? So if you had a $25 strike, you could roll it down to a $24 and move it out to March to earn that premium. So what is nice about it, of course, is earning that premium could be a lot like earning the distribution, right? For not even owning the shares, because you're not having to pay to buy those 100 shares when you sell a put. You're saying you will purchase those 100 shares on that strike date. But currently, I do not own those 100 shares, right? So since I do not own those 100 shares, and this week it does go ex-dividend, I will not receive a distribution for those 100 shares for that put, right? Because I don't own them. I do not own them. So therefore, I need to make that up in receiving premium. And then, of course, if I get assigned those shares, now I own those shares, so I can earn a premium, plus I could sell a call after the X date, so that way I am sure to hopefully still own those shares at X date in order to receive the premium or the distribution for those shares, and then I did receive the premium previously from selling the call. So anyway, I just kind of wanted to show that I am attempting to sell a put on MSTY. I did make a little bit of premium. I got $80 for it, and it does go ex-dividend this week. And if it drops below the 25 and it stays below that by February the 21st, then I will be purchasing those shares at $25 unless I roll it, and I'll determine that at the time of expiration or before. So I'm kind of excited about selling some options on especially MSTY. Seems to pay pretty good premium, as you can see here. I mean, for a little over a month out, it's paying $3.68 premium for a at the money put strike of $27. Now that is close, of course, and I probably would not sell that one because that would be above my cost average. I would want to sell a put option below my average, just so that if I do get put those shares, it brings my average down instead of moving my average up. So anyway, I think I'm going to wrap it up right there for now. Don't forget to like, subscribe, and share this video for others who are looking to maybe do some option plays in MSTY. I'm starting to see some advantages of using the options for MSTY here. I can use it to actually average down and make a premium / distributions. So anyway, don't forget to like, subscribe, and share. And as always, I am not a financial advisor. This is not financial advice. Please do your own due diligence before you get into any stock plays. And until next time, legend out.